Welcome to the Stock Market Palantir. Today we are going to talk about ADTX. ADTX or ADTX is, well, it's one of the most extreme and frankly just wild cases you'll see in the microcap space right now. It's a company that's defined by these huge strategic pivots trying to use a holding company structure to monetize what are, undeniably high potential life science assets. But its stock has just been completely destroyed. So the real question we have to ask ourselves today is this. Is the company's new direction, this BioX-bit transformation, is it a credible, maybe even necessary, attempt to unlock the real value of its assets? Or is the financial history here just so catastrophic that it's trapped in a death spiral?
See, I think you have to start with the financials. I'll be arguing that ADTX has all the classic warning signs of a stock where, structural dilution has basically become the business model. I mean, I think it's fundamentally trapped in a death spiral for any common shareholder, and it doesn't really matter how interesting the assets or the new crypto strategy might sound on paper.
And I completely get the severity of the history. I do. But I'd argue that history is exactly why this BitXBio pivot isn't just, some marketing fluff. It's a strategically necessary and, I'd say, innovative mechanism. They're trying to save these real underlying assets that have significant clinical promise, assets that the traditional stock market, because of all this baggage, just won't fund anymore.
Okay, well, let's start with the reality of that baggage, because that's what determines their runway. ADTX is in a really dire solvency position. I mean, if we just look at the numbers for the 9 months that ended in September 2025, the company posted a staggering net loss of $37.6 million. And get this, against that massive burn rate, their revenue for the period was about $2,770. It's negligible. This isn't a biotech company in the traditional sense. It's a financial vehicle that is just hemorrhaging cash.
Right, but that revenue number, which fell off a cliff, that just confirms that the old strategy failed. That's why the pivot had to be so drastic.
Exactly, but that failure has immediate consequences for their survival. The auditors have issued a formal going concern warning, and for anyone listening, that's a huge red flag. It's the accountants saying they have serious doubts the company can even survive the next 12 months without finding a ton of outside cash. And how have they always found that cash? Through dilution. The horrifying evidence of this is in the reverse stock splits. The cumulative ratio over the last 3 years is more than 2 billion to 1. Specifically, it's 1 for 2,260 million.
That number, 1 for 2.26 billion, is, it's almost a financial novelty in itself.
It's completely unprecedented. It means that if you were a hypothetical investor and you held, say, $10,000 worth of stock at the beginning of all this, your share count has been reduced by that unimaginable factor. It's effectively erased shareholder value in the most aggressive way possible. So this tells me that the primary job of the common stock has been to serve as an endless ATM for the company, which makes it mathematically impossible for shareholders to ever come out ahead.
Okay, I agree. The dilution history is absolutely catastrophic. But that's precisely why we have to look forward at this digital pivot. That catastrophe is the reason it exists. They are trying to tap into the speculative energy of the crypto world to fund serious science that the traditional equity markets have given up on, and the assets themselves are worth fighting for. Pure Santa, one of their main subsidiaries, is working on a blood test for endometriosis. We're talking about a condition that affects 190 million women globally, a market that's estimated at, $1.45 billion? And they started enrollment for their first human study late in 2025. That is tangible progress.
Progress that needs millions and millions of dollars to continue.
Exactly. And then you have Adammune, their immunology division. This is a serious scientific operation with a portfolio of 96 granted patents. They're developing a drug called AD100, and they're preparing an IND application in partnership with the Mayo Clinic, which is a huge stamp of credibility for things like stiff person syndrome. These assets have real intrinsic value. The BitXBio plan, with its digital asset treasury and tokenization ideas, is really management's last shot to get the funding they need before the whole thing collapses.
That's a good summary of the bull case, but let's poke a hole in the core of this BitXBio strategy. I'm sorry, I just don't see how it solves the underlying problem.
The whole thing hinges on building a digital asset treasury, a DAT, backed by Bitcoin and other crypto. But in their own filings, the company admits, and I'm quoting here, it currently holds no digital assets.
Well, you have to start somewhere. They're building the infrastructure first.
But how do you fund it? How do you buy the first Bitcoin for the treasury? You have to raise capital, which means, for now, they have to go back to the same stock market that forced them into that 2 billion to 1 split in the first place. It's a circular dependency on the same toxic financing, often run by firms like H.C. Wainwright. And their deals are notoriously dilutive. They use these unit structures with up to 200% warrant coverage.
Can you just break down for our listeners why that 200% warrant coverage is so toxic?
Of course. So when an institution buys one share in one of these offerings, they don't just get the share. They also get 2 options, or warrants, to buy 2 more shares later at a low price. So in a 200% coverage deal, for every dollar ADTX raises today, they are essentially pre-selling the rights to issue $2 more worth of shares tomorrow. This constant, guaranteed future dilution is just baked into their financing. Slapping the word crypto on the company name doesn't change that fundamental problem at all.
I see your point, but the intent here and the infrastructure they're building, it still offers a way out that a normal stock offering doesn't. Changing the name to BitXBio signals a huge, necessary break from the past. And more importantly, this partnership they announced with Crypto.com for custodial services, that gives them the legitimate foundation for a DAT. Yes, they hold no assets yet, but the goal isn't just to fund the parent company, it's to attract capital using a utility token that's tied directly to the subsidiaries.
A utility token for what, though? What's the utility?
Well, imagine a token that represents a piece of Autoimune's progress on the stiff person's syndrome treatment. An investor who only cares about that specific biotech upside could buy the token, and that money would fund the subsidiary directly. Theoretically, this would let them bypass the constant need to dilute the parent company's stock, which is weighed down by all the debt and liabilities. That's the key idea, to divert the funding stream away from the common shares.
That is a very theoretical leap. It requires a lot of upfront money to build that system to see the DAT and to attract a whole new class of crypto investors. So where does that seed money come from right now? The circular problem remains. You need stock money to fund the crypto vision, but the stock money comes at the cost of killing the stock.
I'll grant you that. They absolutely need some initial capital to prove the concept works before that circle can be broken. It is a race against time. But the very fact that they have a plan to separate the finances of the subsidiary from the parent, that's what creates the speculative opportunity here.
Okay, let's step back from the theoretical future of tokens and look at the cold, hard reality of how the stock trades right now. The price action isn't driven by long-term investors. It's dominated by warrant arbitrage.
That's where all the volatility comes from, for sure.
Exactly. You see these off-exchange short volume ratios that are frequently over 50%. That's a sign of market makers hedging their risk from all the warrants being exercised. And this leads to something called dilution capping. Retail traders see this tiny float after a reverse split and they think, oh, a short squeeze is coming. But if you look at the data, the short interest ratio, the days to cover, is incredibly low. It's like 0.12 days.
Wow, 0.12 days is a striking figure.
It tells you everything. Because of the massive overhang of warrants, if the stock price spikes, the warrant holders can instantly exercise their options at a low price and dump millions of new shares into the market. This flood of supply just completely absorbs the buying pressure. The market makers don't need to panic and cover their shorts because they know a fresh supply of shares is guaranteed to appear. It makes a sustained squeeze mathematically impossible.
That analysis of the pressure against the stock is spot on, and it is absolutely why this is not an investment for the faint of heart. The long-term trend is structurally bearish because of this. But we have to consider the perspective of a very sophisticated short-term trader. The stock is insanely volatile, and the system is clearly under a lot of stress.
What do you mean by under stress in this case?
The cost to borrow. It's been hovering between 18 and 22%. That's really high. It confirms that for short sellers who don't have access to those warrants, the shares are very hard and expensive to find. So you combine that with the low flow and you get this high stakes environment where you can have these really sharp but very brief rallies, and you can see evidence of the stress in the fails to deliver data, which signals the plumbing of the market is struggling to keep up. For a skilled trader, this broken structure can actually be a vehicle to play that volatility, even if we both agree the long-term trend is down.
It's a dynamic game, I'll give you that. But the house, the warrant holders, and the market makers always wins in the end. And the common shareholder is just the liquidity that pays for their win. Let's go back to the intrinsic value you mentioned. Adimmun's Mayo Clinic partnership and Parasana's potential market are real. I get it. But that intrinsic value is totally irrelevant if you don't have the cash to survive the valley of death between research and actually selling a product.
And their answer to that is the planned subsidiary IPOs.
But they're still in that early clinical stage, a stage that needs tens of millions of dollars that ADTX with its $37 million loss just doesn't have. The viability of Parasana's IPO in 2026 depends entirely on them getting good clinical data before the parent company runs out of money. And given the burn rate, that is a serious, serious threat.
With a commitment to spin them off, to hire external firms like Dominari Securities for the Parasana IPO, that is the concrete plan. That's how they separate the parent company's financial mess from the scientific promise of the subsidiaries. They're betting that the market still has an appetite for pure-play biotech companies once they're unchained from this history of dilution.
But you can't just unchain it. The parent company's baggage isn't just internal. You can't ignore the $26 million exposure from the failed Evofem acquisition. That's a huge liability sitting on the balance sheet. If Evofem fails to relist or goes bankrupt, ADTX has to write that whole thing off. That could be catastrophic and could easily get them delisted for not meeting the minimum equity requirements. That clock is ticking really loudly.
The risks are immense, no question. The Evofem liability is like a sword of Damocles hanging over the whole thing. But management is signaling that the potential upside is worth this incredible gamble. The question for a speculator is whether they can use the science story, the Mayo Clinic, the patents, the endometriosis market, to successfully launch this BitAX bio structure and pull in crypto money before the toxic financing cycle eats the company alive.
And I remain convinced that while the science is interesting, the real business model here is and has to be capital raising, not innovation. The 1 for $2.26 billion split is all the proof you need that long-term investment here is structurally broken. Any scientific upside is basically inaccessible to the common shareholders who are constantly being diluted to keep the lights on.
So ultimately, ADTX is sort of two things at once. It's defined by its promising science, but it's also defined by this truly devastating financial structure. The future really comes down to a race. Can the financial engineering, the crypto pivot, and the IPOs outrun the destructive force of its own capital structure? It's a battle between balance sheet mechanics and biomedical innovation.
And for now, the balance sheet mechanics are winning.
ADTX remains a highly complex case study demonstrating the extreme difficulty of funding legitimate life science innovation when trapped within a distressed capital structure. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.